This episode of Industry Focus is brought to you by Rocket Mortgage by Quicken Loans. Rocket Mortgage brings the mortgage process into the 21st century with a fast, easy, and completely online process. Check out Rocket Mortgage today at quickenloans.com/fool. Welcome to Industry Focus, the podcast that dives into a different sector of the stock market each day. I'm your host, Vincent Shen. It is Monday, July 25th. We are pre-recording this episode, partially due to a scheduling need with the studio here at Fool Headquarters, also because I'm just really excited to have my guest today, Rana Pritanjali. So Rana started at the Motley Fool as part of the Analyst Development Program in 2014, about half a year before I joined the company myself. So she's now part of the awesome Inside Value and Income Investor newsletter teams. Welcome to the show, Rana. How's it going?
Thank you. Thanks so much, Vincent. I'm glad to be here.
So I believe we were chatting earlier. This is your first time on a podcast, right? So what do you think so far?
That is true. And you introduced very well. So
Thank you.
Thank you.
I appreciate that. So I hope, not too nervous. I think that you have a lot to share with our listeners today. We're going to be touching on some earnings and just things like consumer staples and the outlook for that industry overall. So I think you're going to do a great job. And why don't we just jump right into it? So something that you had mentioned to me in a conversation we had before the show was just some of your views before we jump into the earnings of the week, which was Unilever, the acquisition deal that they went through. But that's around consumer staples.
Right. So, the consumer staples business, as we all know, is a steady business. And think about it, good or bad times, you're not going to stop brushing your teeth or, taking a shower for that matter. So, the business itself remains very resilient. What has changed over the years is the competitive dynamics of the business. So the first reason is the changing consumer taste. People are willing to try new products more than they used to. And the second and the more important reason is technology. So because of technology, it has become easier for a new small rival to enter into the space. So entry barrier has lowered. And one example is if you want to launch a new product, you have YouTube or Facebook to put your advertisement out. So there are multiple ways now to reach out to consumer, and those ways are cheaper as compared to what it used to be. So that's one part of technology. The other part is that you have Amazon Web Service. So for a new e-commerce website, it's cheaper to, put your website there. And it's further added with Amazon's distribution center, so you can easily distribute your products to people. So because of all of this, sort of you can say the competitive dynamics has changed. And for established players like Procter & Gamble and Unilever Limited, they have to change their strategy. So they have to be more nimble, they have to be flexible, and to an extent, aggressive in their growth strategy. So this is some change which I've seen in consumer staple business over the last 2 years. Okay,
so some of those things that you mentioned with the competitive dynamics, I think they kind of really flesh themselves out and make themselves very apparent with the recent earnings report that we had from Unilever. So
Right.
A few things that I noticed, not only, especially with what you mentioned, the smaller companies having an easier way to get started. An announcement that they made, I think it was maybe the day before they released earnings, was with Dollar Shave Club, which we'll get to. But anything jump out at you from the report? They reported on June 21st. Their stock has been relatively flat since they reported. But anything jump out at you from the report that surprised you or things you'd want to take note of?
Well, I wouldn't say it surprised me, but the thing which I liked was their organic sales were up 4.7%. And organic sales is the sales which are coming from pricing and volume. And this is from the number from last 6 months. And for the quarter itself, the volume was up 1.8%. And I think for consumer staple or for any business for that matter, the only sustainable way for a company to create value over long term or to maintain its competitive advantage is by growing its volume.
Mm-hmm.
So I prefer companies companies that are able to grow their volume quarter after quarter.
And not just build it off of price increases, for example.
Not only build out of price increases, but also by, reducing their operating expenses, which is a good way to create value. But in order to be sustainable for a longer term, you have to grow your top line by growing your volume. So I liked Unilever in that regard. But the bigger news for Unilever from last week was that they acquired Dollar Shave Club for $1 billion.
Yes.
And for our audience who don't know about Dollar Shave Club, all you have to do is go to YouTube, type Dollar Shave Club, and you will have the CEO advertising about their blades, and apparently they're very awesome. So, Unilever paid $1 billion for that. And the company is expected to post $240 million of revenue this year. So approximately the company has paid 4.2 times sales for Dollar Shave Club.
Okay.
Which seems a bit expensive, but if you look at the way Dollar Shave Club has grown over last 3-4 years. So in 2012, they had $4 million of revenue. This year, they're supposed to post $240 million. That's a huge jump.
Unbelievable growth rate. And as you mentioned, considering they only started in 2012, so over about 4 years, they now, I think, have over 3 million members as part of their subscription model.
Yes.
And I think that's, a part of the reason why Unilever was so attracted to this deal was it's a very unique business model, with the subscriptions. I think they offer essentially new razors for as cheap as like $3 per month, including shipping for the consumers. And it's definitely basically changed that part of the industry. I think I saw in a presentation Unilever had mentioned that for male grooming, it's estimated to be a $42 billion market. So this company is still a small piece of that, but they're really they've definitely presented a bit of a conundrum for Procter & Gamble, for example, which is known for like the Gillette brand of razors, which has really hurt, or I guess impacted their business as well.
No, it has hurt their business. Maybe not in terms of value, because as you mentioned, the blades which Dollar Shave Club sells, they are of lower prices. But in terms of the number of people who are shaving or who are using Dollar Shave Club's blade has increased. So that way they have taken share away from Gillette. And also this strategy makes sense for Unilever because Unilever has a massive presence in emerging markets. So around 60% of their revenue comes from emerging markets. Dollar Shave Club sort of gives them an entry ticket to explore their growth territory in the US, so they can, figure out more ways to grow in the US market. So I think that way strategy makes a lot of sense to me.
Do you think just the fact that for example, with Dollar Shave Club, they're able to offer those floor prices, like you mentioned, that potentially Unilever is interested in taking that abroad, where in emerging markets where they might be more price sensitive?
Oh, well, I think right now their strategy is to grow Dollar Shave Club in the US market itself, because sort of their penetration is still very low and there's a lot of scope of growth. Also, Dollar Shave Club has started selling other stuff like gel and other men grooming things. So there's a scope of growth there. So once you have attracted consumer base, you can sell, you can cross-sell stuff and you can grow from there. So I think for now they are looking at the US market. And the CEO of Unilever, Paul Polman, has said that if they will get more such acquisition deals, they are willing to explore that, because it's a way to learn about how technology can make a difference to a sector like consumer staple, which is known to be the steady one.
Yeah, and I think something else that really jumped out at me, just potentially why the company, why Unilever here would be willing to pay a little bit more of a premium valuation for this company, is just the way that they have been so effective with their marketing. Like you mentioned, not only with social media, with that YouTube ad, or the ad that's on YouTube with this, the founder of Dollar Shave Club. I think it has like over 20 million views.
23 million views.
So that was very powerful. And, they also, as a small company, surprisingly kind of jumped into television commercials as well, which was quite surprising for a company their size. And it was very effective. Like, I think it just connected with a lot of their customers who didn't essentially like the previous business model that they were forced to adopt into with the cartridge refills.
Right, and this is the reason why Dollar Shave Club is not profitable yet, because they are spending a lot on advertisement and marketing. But as I mentioned earlier, because of YouTube and Facebook, it has become easier to market your product. It has become easier to reach out to customers. That has lowered the entry barrier. So for a company like Procter & Gamble, they need to be a lot more aggressive and keep all their eyes and ears open that what is coming from where, and just think ahead of the competition.
Okay, so we brought obviously we have Unilever and Procter & Gamble, definitely two of the big names really in this space facing off against each other. One thing that in my research for these companies I've noticed is that Unilever definitely has more of that exposure to emerging markets, for example, and I think that's sustained a little bit the growth that they've been able to enjoy, whereas Procter & Gamble obviously has been going through its own kind of like reorganization efforts. So, but with these two companies, their outlooks, what do you think? Is there anything that jumps out at you just in Unilever, Procter & Gamble, brighter future?
Well, those two are very established companies. There's no doubt about that. So Procter & Gamble has number 1 and number 2 position in most of the categories in which they operate. So that's there. They have Tide, Pampers, and such established brands. So that's there. The thing I do not like about Procter & Gamble is that they have not been able to grow their volume. And as I told you, I think volume growth is important for a company to be sustainable over long term. And they have put a couple of efforts, which I do appreciate. For example, they have slimmed down their portfolio. And so they can concentrate on that 20%, which used to derive almost 80% of their operating profit. So that's one thing. They have also made their operations leaner so that they can have, they can increase their free cash flow margin, which is great. But both of these companies are trading at a forward price to earnings multiple of 21. And this is when Unilever Limited has a better growth prospect. Last 1 year, Unilever Limited has posted a revenue of 4%, while Procter & Gamble has been struggling. I think the revenue growth was around 1%. And it has been so for the last 2 years. And this is the reason why we sold Procter & Gamble in Income Investor, because the company needs to really think out of the box in order to grow its volume. And if you look at Unilever Limited, they have a strong presence in emerging markets, which gives them a stronger, bigger leeway to grow, because you have growth coming from rising income from people trying out premium products. And as a person who's born and brought up in India, I can tell you that Unilever Limited does a very good job in reaching out to not just big cities, but to villages and tier 3, tier 4 towns where they are able to sell their products not just to medium or high income group people, but also to low income group people. So they have a wide variety of products, and they really do a very good job in penetrating to the local markets of emerging markets. So
that's really interesting. Kind of like a first direct experience for you. Then I wasn't aware of that, and I think it touches again on Unilever their strength in some of those markets. True.
So between Procter & Gamble and Unilever Limited, I like Unilever more.
The one thing too that you mentioned just in terms of being more aggressive with growth, I also noticed I think some in their presentation here, just to give everyone an idea on the Procter & Gamble side actually, in the difference that just to give to you the dynamic, 2/3 of their revenue in North America and Europe, whereas which is their more mature and established markets, while their developing markets like Latin America just 10%, all of India, the Middle East, and Africa just 8%, China 8%, Asia 8%. So just a really a big difference from Unilever.
True.
So
and this is the reason why Procter & Gamble has been struggling to grow its volume, because around 60% of its 40% comes from the US, which is sort of a mature market. And emerging market contributes for around 38% of revenue for Procter & Gamble, while for Unilever it is 60%. So, they have a bigger audience to talk to or to sell their products.
Okay, so really great to hear your insight on this, consumer staples with these two bigger companies. But next, I'd kind of like to touch on on one company that actually just reported today, which is Luxottica, and then Time Warner, which will be previewing their earnings as I think they report in early August. But before we move on, I wanted to thank Rocket Mortgage by Quicken Loans for supporting the show. Listeners who have purchased a home in the past or are currently scoping out the market, like myself actually, you understand how frustrating and time-consuming getting a mortgage can be. Fortunately, Rocket Mortgage is bringing the mortgage approval process into the 21st century. With Rocket Mortgage, you can easily share your bank statements and pay stubs at the touch of a button, helping you get approved in minutes for a custom mortgage solution that's tailored to your unique financial situation. And it's fast, powerful, and completely online, so you can do all this from your smartphone or tablet. So if you're looking to refinance your mortgage or buy a home, check out Rocket Mortgage today at quickenloans.com/fool. Equal housing lender, licensed in all 50 states, NMLS-consumeraccess.org number 3030. So moving on, as I mentioned, to Luxottica, which is actually a company I don't think I've covered previously on Industry Focus. They reported earnings about, I think, 2 hours now.
Yeah, that's true.
And they make some very popular eyewear. I think a lot of our listeners will be familiar with. Think Ray-Ban, Oakley, Oliver Peoples. They also license with a ton of world-class names in the luxury fashion industry. So think Burberry, Chanel, Tiffany, more. And another really interesting part of their business is, they have this retail network, 7,200 stores worldwide. So they have chains like LensCrafters, Pearl Vision, Sears Optical, Target Optical, Sunglass Hut. And on top of all of that, they also are the home of iMed Vision Care, which is the second largest vision benefits provider in the United States. They serve almost 40 million people. So, quick rundown. I know they just reported, but anything jump at you from the report?
First of all, you summed up Luxottica pretty well. Even though Luxottica is not so much known to everyone, the brands are, as you said. Everybody knows about everybody knows about Ray-Ban and Oakley. So I was just looking at their numbers. I haven't had a chance to look at the transcript. So the core sales was up 1.6%. Operating income was up around 1.5%, which I won't say is great. It was, I think if I have to evaluate their result, it was sort of below my expectations. And the company has lowered its forecast for the next half of the year. So now they're projecting 2 to 3% of growth in revenue for the year, as compared to what it was. They were earlier projecting 5 to 6% growth for the year. Also, the company's long-term strategy is to grow their operating income 1.5 times revenue. For this year, now they're projecting one time, the revenue.
Yeah, just one time. Yep.
One time revenue. So that is there, but over the long term, I think the company has a lot of potential to do well. And the reason is that eyewear industry is structurally growing market. For next 5 years, the industry is supposed to grow at 3.7%. And that makes sense. If you see more and more people are using electronic devices, so they will go for eye checkup, and there is going to be a need for, eyewear industry. Also, as we are having global warming, there are more and more people who are going to use sunglasses across the world. So from these tailwinds, I think there is a way for the company to grow. And Luxottica's market share is 60% in the market in which it operates. So they are sort of top dog. They are
dominant player.
They are a very dominant player. And also, the company is not a completely discretionary business as we think of eyewear businesses, because 46% of revenue comes from prescription frames.
Yes.
And lenses, while 54% comes from sunglasses and the luxury branded glasses. So that provides some sort of consumer staple, side of the business. So, even good or bad times, if you need glasses, you will need glasses, right? So that's there. And also, because the company is vertically integrated, it helps the company to launch the product quickly and to understand the consumer well. So, Luxottica takes a lot of pride in the fact that the company is able to design, test, and launch the product, design, manufacture, and launch the product all in the same day. They move their supply chain so quickly. So that puts Luxottica ahead of competition, I would say, with such a huge market share, with a growing market. And as you said, they have a brand which resonates well with everybody. Luxottica has a lot of scope of growth in future.
Absolutely, Rana. I think the really important and cool thing about this, the company that you touched on, was that vertical integration, where it's I think they have like 6 production facilities or something along those lines. 3 in Italy, 1 in China, I think 1 in the U.S. as well.
Right.
But being able to go from for Ray-Ban or for Oakley, like you mentioned, from the production, from their design to the production, and then they have this giant network of retailers to sell it through for the distribution.
Right.
It's very powerful.
Yeah, and since the manufacturing capability is so strong that even if a company like Chanel or Prada wants to manufacture its own glasses, they will tie up with Luxottica in order to do that. So the company itself, like they literally dominate this market. So
And one point I would like to leave with listeners and people who are interested in Luxottica is the idea that the business is still very focused in Europe and North America, especially if you're looking at it in terms of it being more of a luxury brand. I think 79% of its sales in its last quarter that I have the financials for, not yet for this most recent reported one from today. So it's a large runway for developing markets.
Oh, there is, and they are looking into that market. They have been tying up with local companies where they can use their own technology, their technology and their experience to launch their products into emerging markets. So definitely that's the case.
Okay. So we have a few more minutes here. I wanted to wrap up on Time Warner, and they report earnings on August 3rd before the market opened. So there's been a lot of chatter in the investment community after Netflix kind of took a beating for its latest report. Dylan Lewis and Simon Erickson actually have a great show on this from July 23rd, an industry focus. So Time Warner, their 3 primary business segments are Turner, HBO, and Warner Brothers. Turner, think the TV networks, HBO obviously the premium service, and then you have Warner Brothers, which is some of the television shows and obviously the big blockbusters that they produce. Yeah. And for me personally, I was really excited. I actually saw a lot of the Comic-Con trailers that came out for Warner Brothers movies, like Justice League and things like that came out over the weekend. A lot of buzz around those, but I'd love to hear what you think, kind of investors should be looking for in this report, what to expect maybe longer term as well.
Right. So my investment thesis for Time Warner, and we own this company in Inside Value, and I own it myself as well. So my investment thesis for Time Warner is there is going to be a change, and the change is already happening in the way consumers watch television or watch entertainment. But in this whole entertainment ecosystem, content provider and good content provider are always going to win. And they are always going to have a dominant position in this whole ecosystem. And for a company like Time Warner, which has HBO as I think that's a very valuable asset for the company. And they also own channels like TBS, CNN, Cartoon Network. So they sort of provide a whole entertainment package, whole family entertainment package where you have something for kids, you have something for adults. So I think Time Warner is going to be dominant in coming years. And the company is trading at a price to earnings of 16, which is like a lot of pessimism has been priced into the stock, I would say. And if you look at Turner, they have 3 of top 10 ad-supported cable networks. So if you decide to slim down your cable channels and you decide to keep, let's say instead of having 100 channels, I just want to keep 15 or 10 for that matter, I think you will end up keeping channels that are owned by Time Warner.
Part of that business.
So coming to earnings, a couple of things which I will look for is how the subscription growth is going on in HBO, what kind of subscription growth they're reporting. They just showed their finale of Game of Thrones, and apparently they had like 8.9 million viewers just for the finale, which is 10% higher than what they had in season 5 finale.
In the previous finale, yes.
Last year. So that's one thing. I will also keep an eye on the churn rate, like how the traditional TV is going. So what churn rate is, how many people are canceling their subscription. So that's one thing. Then another metric which I will like to look at is the engagement metrics, which they show that, how many people are watching their top prime show, or I have the number for Game of Thrones, a similar number for other channels as well.
Okay.
So yeah, that's all.
Okay, so I think with HBO, especially with Game of Thrones, they've obviously very well-known network. They've won so many awards for their content especially at HBO. It's definitely a very powerful business. Some people, I think, are kind of nervous because it's only got a few more seasons, and HBO is kind of on the hook to try and replace that. But I think at this point, they've generally proven themselves to be very savvy about keeping a pulse of what viewers are interested in and keeping, this string of winners coming.
Right.
But, that is something that all of these content providers, challenges content providers face is, making sure that what they put out is, popular with viewers.
Yes, and that is true for every content provider, as you said. So the strategy is to keep launching new products, or you can say new TV series, and this is where experience does matter.
Yeah.
Time Warner has done a superb job in coming up with series that resonates very well with its audience, and I don't see the reason why that should change. The other reason was that initially Time Warner sort of was apprehensive of cutting its ties with cable companies, where now Time Warner has become a lot more open about going to customer with its own network or with its own apps, where you feed your series to customers, or consumer has an option to watch video as per their time and or the way they want to consume content.
With the direct HBO services, for example.
Direct HBO services, right.
Okay. So any other thoughts for Time Warner otherwise going forward?
No, I think the company is doing exactly what it's supposed to do, investing in the content, investing in technology so that it can, it is able to provide entertainment to consumer at their time and the way they want to.
The way they want it, absolutely.
They want to.
So just another reminder, if you're looking for those results, they are reporting on August 3rd before market open. Otherwise, thanks a lot, Rana, for joining us today.
Thank you. It was glad to be here.
Yeah, no problem. So that's a wrap for us today. You can continue the conversation with us via Twitter at MF Industry Focus, or send us any questions or comments via email to industryfocus@fool.com. You can also enjoy the other great podcasts from The Motley Fool by checking out fool.com/podcasts. People in the program may own companies discussed in the show, and The Motley Fool may have formal recommendations for or against stocks mentioned. So don't buy or sell anything based solely on what you hear during the program. Thanks for listening, and Fool on.